The FedLife podcast is presented by Serving Those Who Serve, a fiduciary, fee-based financial planning firm serving federal government employees and retirees all over the country. This podcast is for informational purposes only and is not intended to be taken as financial advice. All listeners should consult their personal advisors before taking any action. The opinions expressed by our hosts are their own and do not reflect the views, policies, or position of Raymond James. Securities are offered through Raymond James Financial Services, Inc., member FINRA SIPC. Investment advisory services are offered through Raymond James Financial Services Advisors, Inc. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services, Inc. And now, here are your hosts. Dan Sipe serves as a branch manager for Raymond James Financial Services and Serving Those Who Serve. Ed Zerndorfer is our guest and federal benefits expert in the space.
Welcome, everyone, to this episode of the FedLife podcast. I'm your host, Dan Sipe. Additionally, I'm the branch manager at Raymond James Financial Services, as well as Serving Those Who Serve at Lee Sipe Associates. I will begin, as I always do, by saying thank you. Thank you for taking the time to listen, but above all, thank you for your service to the government, to the country, to me, to everyone. You don't hear that enough. You're always going to hear it here. The other thing you're always going to hear with me on the Fed Zone or the FedLife podcast is Ed Zerndorfer. He's back with us once again. Yes. The guru is here as part of our ongoing mission to reach, teach, and serve you, the career civilian feds. Once again, we are following Ed's Fed Zone articles, one more way to reach and teach. And today we got one that I'll bet you most feds don't encounter, but boy, howdy, if they do, they need to understand it, know what to do. And in this case, Ed, you wrote an article about the possibility of someone having excess elective deferrals. Wow. That sounds like a mouthful, and it sounds like something that has a little weight to it. So what is an excess elective deferral?
Yes, Dan. In order to understand what an excess elective deferral is, let's talk about the TSP. Let's talk about the TSP because it applies to the TSP. Or if you work in private industry, if you are participating in a 401k plan or a 403b plan. When I say participating, you are contributing. What are you contributing from? Your salary. So these are considered the TSP, the 401k plan, 403b plans are qualified retirement plans. Now, what do I mean by qualified retirement plans? They have to fulfill the rules of certain rules under ERISA, and one of those rules is that an employee can only contribute a certain amount of their paycheck into these plans each year. When I say these plans, I'm including pre-tax plans, traditional TSP, traditional 401k plan, as well as after-tax plans, the Roth TSP, a Roth 401k plan. An employee is limited how much they contribute each year from their paycheck. These are called elective deferrals. Now, who determines the limit each year? The IRS. For example, Dan, during 2023, a federal employee could contribute a maximum 23 federal employee who was under the age of 50 could contribute a maximum $22,500 to the TSP during calendar year 2023. If an employee was over the age of 49 as of December 31st, 2023, they were born before January 1st, 1974, they can contribute an extra $7,500, so-called catch-up contributions, for a total amount, that's the total amount of their deferrals during 2023, of $30,000. Now, let's suppose an employee contributed more, employee younger than 50, more than $22,500 to their qualified retirement plans. Let's do an example.
Sure.
Let's say a federal employee retired on June the 30th, 2023. They retired on June 30, 2023.
Gotcha.
Now, that employee, and I get this question so often during webinars, Ed, I'm going to retire on June the 30th, 2023. According to what the TS rules are, I can only contribute during calendar year 2023 $22,500. I'm going to retire. Does that mean I only can put in half of that? $11,250? The answer is no. You're not limited to what you contribute during the year if you retire in the middle of the year. But that's the maximum contribution for the year. So the employee says, wonderful. Then I can put in the full $22,500. But my last opportunity will then be my last pay date, my last pay period, when I get paid. When I get paid for the last pay period, that'll be my last opportunity to contribute to the plan for the year. And it can be a maximum of $22,500. Yes. Fine. But then the employee gets another job. They work in private industry. They found they were the job in which their employer they're going to be working for offers a 401k plan. Listen to this. The employer gives an 8% match. And the employer is going to start, this retired federal employee is going to start his or her new job on August the 1st, 2023. And said, boy, with an 8% match, I'm going to put in the maximum possible. I'm going to put the employee between August 1st, 2023 and December 31st, 2023 contributed $12,000 to that 401k plan. $12,000. Wow. What happened here? The employer put in how much to the combined TSP and to their 401k plan? $22,500 to the TSP, another $12,000 401k plan for a total of $34,500. Guess what, Dan? They have excess elective deferrals because the IRS says you can't do that. When you reach that elective deferral limit, $22,500, if you're under 50 during 2023, or if you were over 50 during 2023, over 49, age 49, I should say, during 2023, a maximum of $30,000. You have excess elective deferrals, and you have to back out those excess deferrals. Because if you don't, you're going to pay a penalty. So that's what's called excess elective deferral. It applies to contributions you make to the pre-tax traditional TSP. It applies to after-tax contributions you make to the Roth TSP. Combined. It makes it.
Cool. Now, Ed, in your article, you also talk about this happening with civilian and uniform services TSP, and that makes all the sense in the world, because if you've got an ambitious person in military service and they know they're going out mid-year, they want to make sure they get the maximum in TSP, they may go ahead and do that. And then they start with civilian and they start making those contributions, they're running into the same thing. So how might that be fixed?
Well, actually, there's good news here, Dan. There's good news because the TSP is going to fix it. The TSP does that. They will back out the excess contributions from the uniform services. This sometimes happens, by the way, when a civilian federal employee goes on active duty. They're called up. They got to go on active duty. And when they're on active duty, they're allowed to contribute to the uniform services TSP. They're on military leave, and they're not contributing to the civilian TSP.
Sure.
Instead, they are contributing to the uniform services TSP. Then they get off of active duty. They're no longer on active duty, come back to their civilian job, and restart contributing to the traditional TSP, to the civilian TSP. So at the end of the year, they may have, in fact, contributed when you combine what they contributed to the civilian and to the uniform services TSP, they in fact may have excess elective deferrals. But There's one difference here. The TSP automatically will back out the excess elective deferrals. The TSP itself does that. They do that themselves.
Gotcha.
And it's not only the excess elective deferrals, but also the earnings on those excess deferrals have to be backed out. Backed out. And one other thing here we didn't mention a couple minutes ago, that when I say excess elective deferrals, that does not mean the agency matching contributions. That's not part of this.
Okay.
Elective deferrals are defined as contributions that an employee makes from his or her salary, their compensation. The agency, in case of FERS employees, the agency, 1% of gross pay automatic contribution the agency makes, and the agency matching contributions up to maximum 4%. The employee has to contribute a minimum 5% to get the maximum 4% match, are not part of elective deferrals. They're not part of the elective deferral limit. Okay. So I want to make that clear.
So if we had the situation where somebody, with their previous employer had maxed out and then joined federal service, and now they're contributing to TSP that's putting them over, and they're getting those matches, TSP is going to have to deal with the deferrals and deal with the earnings. Does that mean the matches stay?
And then what we're talking about here, an employee, federal employee who contributes both to the traditional, to the TSP and has an outside 401k plan. Typically this happens when somebody comes in mid-year.
Sure.
The plans, believe me, the TSP does not communicate with that previous retirement plan.
Understood.
It's the employee's responsibility. And what happens as far as the match is concerned, it has to be back out. No, before we get into the details here, it's the responsibility of the employee if they know they made excess elective deferrals. The TSP is not going to know anything about that. How would an employee know they made excess elective deferrals? Where is it listed what they contributed during the year to their respective retirement plan?
Well, they'd have that on their statement, right?
No, not really. It's going to be on their W-2.
Got it.
During this past month, January 2024, federal employees got their W-2s. And on their W-2, in box 12, there is a code that shows what they contributed to the TSP. Now, I think there are two different codes depending on which TSP account or accounts they contribute. When they contribute to the traditional TSP, there's a code D. D as in David. It shows the amount they contributed to the traditional TSP. And then there's a code A if they contributed to the Roth TSP. It shows the total amount. The same thing is true when they work for that employer, that private employer. The private employer sent the employee a W-2 reporting their compensation during calendar year, let's say 2023. In box 12, it shows what they contributed to their pre-tax traditional 401k plan. The employee has to put two and two together. Oh, sure. I contributed too much. And at that point, they really should show it to their accountant. As an accountant, Dan, I'm getting now we're in tax season, I'm looking at those W-2s. When I have somebody who worked both for the federal government, I'm a federal employee, and worked in private industry, I'm looking at box 12. And I'm doing a little issue. I had a case a couple years ago like that, where a federal employee did retire middle of the year, then worked for a private employer, contribute the max to the TSP, and also contributed almost the maximum to their 401k plan. And I told him, you made excess elective deferrals. He said, what do I do? I said, you got a choice here. You have to contact either the TSP or your former employer, the 401k administrator. You have to back out the excess contributions. It's your responsibility to do that. Now, as far as the TSP is concerned, and I wrote about this in the Fed Zone, that a federal employee who made excess elective deferrals to the TSP and to another retirement plan can, if they want to back out the excess contributions to the TSP, like excess elective deferrals to the TSP, they have to go online to their account and complete form TSP-44402G. It's called a refund request form TSP-44402G. And the employee has to fill it out, and it has to be submitted to the TSP no later than March 15th, 2044. Now, I will tell you, though, that form TSP-44402G is only only going to be on the employee's TSP account, only going to be up there until March 15th. At that point, it's going to be taken down.
Gotcha.
That's their deadline. They got to have to complete that form. Why? Because the TSP's got to do some work here. If they said they want it, the TSP is the one who's going to be backing out the excess deferrals. Okay. And the TSP will, if it's done timely, will back out the excess elective deferrals no later than April the 15th, and will notify the employee about that. And the employee should be getting a corrected W-2 statement showing that there's no excess, showing the amount of what it should have been in terms of the elective deferrals. And what happens if the employee doesn't do that?
I'll bet there's consequences.
There's always consequences when you don't do things. The employee is going to be paying it's going to be subject to a penalty. It's called the IRS's excess contribution penalty.
Ouch.
The employee paid excess contributions to his or her qualified retirement plan. What is that penalty? 6% of the excess elective deferral. So an employee, like we're going back to an example I shared. The employee made an excess contributions of $12,000. They put $22,500 to the TSB during 2023, and they put $12,000 into their 401k plan. So, what is the penalty here if they don't back out the excess $12,000? 6% of $12,000 is $720. Ouch.
Gotcha. Yeah.
Okay. And then it's by year. For every year, the $12,000 is not backed out. If they don't back it out by December 31st, 2024, guess what? There's going to be another 6% penalty assessed next year.
Wow.
As well as interest penalties.
So let me get this straight, Ed. So if this happens, you need to have it straightened up before April 15th. Because if you file with the excess elective deferrals in place, you're going to have a penalty for that year until you fix it. Correct?
That's correct. That's correct that year.
That's brutal.
One of the things I get sometimes reactions from clients when I tell them about this. And this, by the way, the excess contribution penalty, that 6% applies to excess contributions made to IRAs. IRAs have separate limits. And some clients say to me, how are they going to know? How are they going to know about this? I
W-2,
said,
buddy.
I'm not going to tell them. I'm not going to tell them, but I will tell you on your W-2 statement, they add it up. They can see there's an excess because, again, each employer has to report the amount of contributions. As far as IRA is concerned, in reality, they wouldn't. They're making because IRA contributions are not reported on a W-2. But
yeah,
you got to do it.
Oh, absolutely. Absolutely. Wow. Once again, brother, you're the only person writing about this stuff. And folks, I hope you never run into this. But if you do, I hope this article, this podcast puts you in a position where you can get it sorted before the 15th of March of this year. So, friends, if you're watching this and you know somebody who joined federal service last year coming from another job, just share this with them. It may not apply, in which case they go, no, not me. But if it does, and you're saving them a 6% hit that's unexpected on their taxes, they're going to thank you for it. So, Ed, again, wow. Thank you on behalf of all our feds. Thank you on behalf of our team here, to just help keep our level of understanding right up here, do the best work we can. You're awesome, brother. Thank you.
Our pleasure. Our pleasure. And I just want to mention one other category of this who could apply to, like my example, somebody retired in the middle of last year as a federal employee, put the maximum to the TSP, then they got a job. They got a job in which there's a qualified retirement plan. They want to take full advantage of it. I can understand that. But they may have, and they should look at their W-2s. The federal they got the W-2 they got from their agency from 2023 and the W-2 they got from their private employer. Go to box 12, add up the contributions, and you can see right there that whether you made excess, whether you have excess elective deferrals, and if you do, what you have to do, you can go back to your employer, to your current employer, and say you need to talk to the administrator of the 401k plan, or you can go to the TSP using that, go into your online account, requesting that form, that TSP-44402G. And again, you can read about it in the Fed Zone. That column came up a couple of weeks ago. I always write this column in January because it's timely. Okay,
yep.
It'll be coming out again next year, but again, do the right thing if you're affected. And
absolutely.
Note the March 15th deadline.
Yep. Well, folks, that's a wrap. We are Serving Those Who Serve, so be sure to subscribe to this podcast. Hit that subscribe button on our YouTube channel, also on Spotify. Please remember to share it with your friends and strangers. Check us out on Twitter and LinkedIn, and don't forget those live webinars every single week. Head to swserve.com. You'll see the webinar button. Click it. It's going to take you to the whole menu. Tons of information there. Guru comes to you. Reach you where you are, teach you where you are, and above all, serve you where you are. Sign up for one, sign up for all. Share the page with your friends. They will thank you. Be sure to read Ed every single week in the Fed Zone. You will not regret it. There are tons and tons of information that he's putting out every single week that you're just not getting anywhere else. So that's at fed-zone.com. So for Ed, the crew at Serving Those Who Serve, and me, Dan Sipe, closing as I always do by saying good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.
Bye-bye.